This episode is brought to you by Shopify. Whether you're selling a little or a lot, Shopify helps you do your thing, however you cha-ching. From the launch your online shop stage, all the way to the we just hit 1 million orders stage. No matter what stage you're in, Shopify's there to help you grow. Sign up for a $1 per month trial period at shopify.com/special offer, all lowercase. That's shopify.com/special offer.
This podcast brought to you by Ring. With Ring cameras, you can check on your pets to catch them in the act.
Izzy, drop that.
Or just keep them company.
Aw, I'll be home soon.
Make sure they're okay while you're away. With Ring. Learn more at ring.com/pets.
This is Optimal Finance Daily. Why You Should Be a Lazy Investor Instead of a Stock Picker by Michael L. with financialpanther.com. And I'm your host and personal finance enthusiast, Diana Merriam. Now let's get to today's post as we optimize your life. Why You Should Be a Lazy Investor Instead of a Stock Picker by Michael L. with financialpanther.com. Simplicity. It's what we all want to achieve in every area of our lives. That's why we have Netflix instead of cable. Plus, it's cheaper. Endless 2-day Amazon Prime deliveries, or Postmates making your favorite restaurant deliverable. This post will show you how simple it is to do even in your financial life. Hopefully by now you understand how important it is to invest in the stock market to grow your money over time. As the saying goes, no one ever got rich from a savings account, especially nowadays with less than 1% interest. But the next question many people ask is, where do I invest? Should you buy stocks, bonds, mutual funds, gold, or tons of other options? This question alone shows why a lot of people avoid the market entirely. It's complicated. Honestly, you don't have to be a genius, Wall Street guru, or financial analyst to be a smart investor at any age. All you need to do is focus on investing in low-cost index funds in your 401k, Roth IRA, or brokerage accounts instead of picking individual stocks. Make it a habit over time and your money will be diversified, have low management fees, and track the market, which historically over time has averaged roughly 8% returns over the past century, slightly better than your 0.1% savings account. While everyone wants to be Gordon Gekko or Jordan Belfort as a stock-picking guru or day trader, the chances of success are very small for the average investor. Picking stocks is expensive, takes time to research the companies, and can be a lot riskier than index funds. By picking stocks individually, you, number one, have a lot of your eggs in one basket. Example, if the company has a bad earnings call or something affects the stock, your investment will be directly related. Number two, live and die by one company. This happens a lot when people invest their 401k or employee stock into their employer. There may be benefits, but it can also cloud your judgment as you're already emotionally invested in the company. And number three, have to stay actively engaged and research the stock. Who wants to read earnings calls, understand a balance sheet, and learn their price to earnings ratio? Just writing that made me bored. Is index investing as sexy as buying Netflix years ago and making 300% gains? Or Amazon or Apple a few years ago? The simple answer is no, but unless you have a few hours a week to study each stock in your portfolio, don't bother with individual stocks until you have a decent amount of wealth built up. Instead of stock picking, focus on index funds. What's an index fund? As the name implies, index funds follow a specific index, like the S&P 500 or Dow Jones. Historically, these have returned about 8 to 9% annually. While you may get more in some years from individual stock picking, you may also lose a lot more on down years. Index funds try to keep performance consistent and reliable. Investopedia defines it as, quote, a type of mutual fund with a portfolio constructed to match or track the components of a market index, such as the Standard & Poor's 500 index or S&P 500. An index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. End quote. Basically, it means that index funds are a single fund that invests in hundreds of individual stocks or bonds. Let's look at an example to simplify. VTI, the stock ticker symbol, is known as the Vanguard Total U.S. Stock Market Index. The 10 biggest stocks in the fund are very big companies and would take thousands of dollars to invest in each company. Instead, with an index fund, you get to be partially invested in all of these big 10 companies and thousands of others instead of buying each stock individually. This is an example of an index stock fund, meaning no bonds are in these funds. Now you've understood the hard part about the original question, where do I invest my money? Next up is understanding how to be lazy with your portfolio to keep the theme of simplicity going. In fact, you want to make your strategy as lazy as possible, which is known as a lazy portfolio. This is the only time I'm asking you to be lazy in life, but it's a strategy I have implemented and don't have much stress when it comes to contributing to my portfolio. Lazy portfolios are meant for you to be able to invest in a few funds and be fully diversified with just a few clicks. Make sure you're comfortable with your asset allocation and figure out which percentage of stocks to bonds will match your risk tolerance. Here's an example of a 2-fund portfolio, which is great if you're just starting out and think investing is hard. Lazy portfolio example: VTI, Total U.S. Stock Market, and BND, Total Market Bond Fund. Pros: low management fees, which means you keep more money. Low minimum investment, 1 share of each. It's passively managed and diversified. At the time of this article, between the 2 funds, you have 3,682 stocks in VTI and 7,911 bonds in BND. Cons: it doesn't have any international exposure. This portfolio is good for beginning investors who don't have a ton of capital and want to keep it as simple as possible. It can also be a great place to start and build upon. If you'd like international exposure as well, look at VXUS, which is a total international stock fund that's currently invested in 6,041 different international stocks. By choosing 2 or 3 funds, you have an extremely low-cost, diversified portfolio. Does this seem much easier than studying and buying each stock, or even the top 10 in the funds? It should. Most people don't invest until it's too late because it seems tedious. They don't understand how or where to invest, and because it requires constant upkeep. And who wants that? Lazy portfolios are the exact opposite and make your life simple. Next time you decide to procrastinate on making your first investment, listen to this post again to remember how simple this is. Lazy portfolios will let you set it and forget it. And that's the goal, to keep our lives simple and easy. You just listened to the post titled, "Why You Should Be a Lazy Investor Instead of a Stock Picker" by Michael L. with financialpanther.com. And I'll be right back with my commentary.
This episode is brought to you by Shopify. Whether you're selling a little or a lot, Shopify helps you do your thing, however you cha-ching. From the launch your online shop stage, all the way to the we just hit 1 million orders stage. No matter what stage you're in, Shopify's there to help you grow. Sign up for a $1 per month trial period at shopify.com/special offer, all lowercase. That's shopify.com/special offer.
My dad works in B2B marketing. He came by my school for career day and said he was a big ROAS man. Then he told everyone how much he loved calculating his return on ad spend. My friends still laugh at me to this day.
Not everyone gets B2B, but with LinkedIn, you'll be able to reach people who do. Get a $100 credit on your next ad campaign. Go to linkedin.com/results to claim your credit. That's linkedin.com/results. Terms and conditions apply. LinkedIn, the place to be, to be.
As much as we work to demystify things like investing on this show, the reality is that passively investing in index funds is relatively boring. I can assure you that my investments aren't where I get my kicks. While the financial services industry might make it look like you need to try and beat the market to succeed with investing, this simply isn't true. You can reach your financial goals over the long run by just matching the market through long-term index fund investing. The reality is that the investors who are getting the best results aren't messing with their investments constantly. I'm reminded of a famous quote from Jack Bogle, who's the father of index funds, when he said, quote, "Don't do something, just stand there," end quote. In fact, a number of years ago, Fidelity did a study where they looked at which of their accounts did best. And it turned out that they were the accounts of people who forgot that they had an account at Fidelity. It really is possible and beneficial to be a lazy investor when you focus on index funds. And that'll do it for today. Have a great day and start to your weekend. Thank you for listening, and I'll be back here reading to you tomorrow, where your optimal life awaits.